At the start of 2001, Enron was the blueprint for large corporations, boasting 30,000 employees and an annual revenue of $100 billion. But by the end of the year, the company had garnered the title of biggest bankruptcy of all time, while Arthur Andersen, one of the Big Five, suffered a similar fate for their part in the scandal. So how did the energy giant, once valued at $70 billion, go from winning Fortune's most innovative company for 6 years in a row to bankrupt in the space of just a few months? Here's a story of fraud, corruption, and serious mismanagement. Here's how it happened. For some background, Enron was founded as a result of a merger between energy firm Internorth and utility company Houston Natural Gas back in 1985. American Ken Lay was appointed CEO, and legendary artist Paul Rand, who also made the logos for IBM, UPS, and ABC, designed the now infamous Enron E. The energy market underwent significant deregulation throughout the 80s and 90s, leading to extremely volatile prices and a belief that anything was possible as companies rode the bull market that followed 1987's Black Monday. Enron then opened its own trading subsidiary to maximize profitability, and Jeffrey Skilling was appointed CEO of Enron Capital and Trade in 1991. Skilling oversaw the introduction of mark-to-market accounting within the corporation. That is the practice of valuing your assets based on predictions of their future prices rather than on historical prices. And in short, it basically gave Enron the right to decide their own profits, without being held accountable for the accuracy of the valuations. Based on these optimistic calculations, Enron's revenue figures began to skyrocket as the 90s wore on. The firm was named as Fortune's best company to work for in 2000, as its stock price peaked at $90 a share, and its directors outlined their expectation of even further profits in the near future. As Enron invested hundreds of millions more into projects both in the US and overseas, the company was able to hide these losses behind false estimations of the new asset's value, like a power plant in the northeast of England. To cover any reported losses or cash flow issues, Enron would borrow money from its SPVs, special purpose vehicles, which were subsidiaries of the corporation capitalized with Enron stock, making it impossible for the lenders to retrieve their money if the energy company was struggling. The crashing of the dot-com bubble in 2000 hit Enron's assets hard, as they had now diversified into industries like video on demand and high-speed broadband networks. Investors were becoming more cautious and increasingly skeptical of the firm's complex business model, and by early 2001, serious questions were being asked of Enron's financial statements. Lay stepped down as CEO in February to be replaced by Skilling, with Enron's stock price halving to $40 in the 6 months that followed. Amid widespread speculation about the company's accounting methods, Skilling stepped down from his new role in August 2001. As Lay returned to his former position, analysts were downgrading Enron's stock rating, and Lay began selling millions of dollars worth of his shares in the firm. In October, Enron announced its first quarterly loss in 4 years thanks to taking charges of $1 billion from its underperforming assets, and the SEC began a formal investigation into its financial statements. During November, the company revealed it had overstated its profits by $591 million between 1997 and 2000. Meanwhile, over 20,000 of its employees' 401k pension plans were locked for 30 days due to a change in administrator. A merger was agreed with close competitor Dynegy, but was called off due to concerns that Enron was still lacking transparency in its off-balance sheet debt. And on the 30th of November, the company's stock price hit rock bottom at just 26 cents a share, down from $80 back in February, and Enron filed for bankruptcy protection 2 days later on the 2nd of December, marking less than a year since it became the 7th biggest corporation in the United States. Thousands of employees lost their jobs and their life savings, and shareholders eventually sued banks like JP Morgan Chase and Citigroup for conducting deals with Enron, later winning $7.2 billion that was shared among the 1.5 million victims. Several executives went on trial for a range of charges related to the company's nefarious activity, including Lay and Skilling, who were charged with a total of 39 counts of fraud and conspiracy between them in January 2006, to all of which they pleaded not guilty. Lay died of a heart attack before the sentencing, but Skilling was sentenced to 24 years, of which he served 12 before being released in 2019. Not exempt from punishment were Enron's auditors, Arthur Andersen, who were one of the Big Five accounting firms, and also had their reputation dragged through the mud for their compliance in the fraud. They were found guilty of destroying documents that were of relevance to the SEC, which was caused to void their auditing license and leave the firm with no choice but to close. Hence their absence from the Big Four we know today, although their consultancy branch does still remain in operation as Accenture. The fiasco saw the United States Senate impose much tighter regulations to prevent a repeat in future, namely the Sarbanes-Oxley Act, which created a board to oversee audit reports for public companies and strict controls on what services these auditors could provide, not to mention the requirement for executives to sign off on all financial reports, meaning they could no longer plead ignorance to their firm's wrongdoings. Undoubtedly, the effects of the Enron scandal are still felt in the finance industry today, so let us know your thoughts and what you think the next Enron might be. And that's how it happened. Thanks for watching.
Hello, welcome. So we've got a good one today. So my name is Kevin Gerard Millette II. I am the New Bedford Nostradamus. I predict the future, and I'm also part of the mass chapter of Doge. Couple of disclaimers before we get started. One, we are going to talk about billions of dollars. If anything happens to me, I am not suicidal at all. Not suicidal at all. I have a lot of questions. And there's a lot of funny business going on, or it looks like that. That's what my perception is. And so, disclosure number one, I am not suicidal. Disclosure number two, although I do say I'm the mass chapter of Doge, I have no relation to Musk. I was thinking about maybe a few months back when they started doing all the investigations, what it would be like to be an investigator. What does it mean to be like an IG, an inspector general? And I started looking, and what I realized is that you pretty much as a citizen have the same ability to request and pull and review information as an IG, minus some probably some critical items, but for the most part, the citizens have that through FOIA requests and whatnot. So as we go through Massachusetts right now, there's a lot of talk about audits and votes for audits and audits not being performed, but that's a myth. We don't need them to do an audit. We can do our own audit. So just remember that. Third, I am investing. I opened up a Merrill account over the weekend, and I will be putting some financial options against Eversource. So if the stock does collapse, I do intend to make money off of it. That might make you think that I'm biased, but after what I tell you, you're not going to care. I think that's what I needed for disclosures. So what we're going to be doing is talking about, this is going to be information dense, right? So we're going to be covering a lot of information, and it's probably going to be confusing, and rightfully so. Because it's just, these big things, it takes a lot of eyes and it takes a lot of investigating. I myself have poured quite a number of hours. The one last disclosure I will make before we get started is that I try to source all my sites. I cite all my sources, and I will be putting on the description sections of the videos a list of sources, public sources that I utilize to gather this information. Is it correct 100%? I did my due diligence as best I could to make sure that the information was correct, but I'm using a combination of public sources and AI to distill a lot of dense documentation and information. So there may be mistakes, and I rely on you to call them out when you find them. So if you watch the video, if you were there before, it's about a 5 to 6 minute foray on the Enron scandal. So this was back in the early 2000s. There was a major energy company. Let's pull this up here. There was a major energy company that it started off as a regular gas company, and through mergers and acquisitions and growth, they ended up becoming a more of a trader, right? So they would speculate on energy and trade energy futures. So we saw in there was Kenneth Lay, the CEO, Jeffrey Skilling, the COO, and eventually became the CEO, and then Andrew Fastow, the CFO, all of which saw charges. Unfortunately, Kenneth died before the actual charges were brought up, but they did see some significant time. Some of the things that are interesting about the structure and what they had, how this kind of whole thing started to draw up, was the subsidiaries. So Enron facilitated or worked with a complex web of subsidiaries, and what they were doing is they were offloading the debt to make their books look good in a giant nutshell, and they were using borrowing and leveraging in order to continue to play this shell game. Unfortunately, it ended up crashing down after analysts started asking questions about things because it just didn't add up. There were a slew of regulators here, the SEC, the FERC, the PCAOB. You guys can look these up. I mean, the Securities and Exchange Commission, they're responsible for all the stock trading. Let's go. I got some. The Federal Energy Regulatory Commission, the FERC, they're responsible for making sure that energy markets and prevents price manipulation, which they sure did. The PCAOB, or the Public Company Accounting Oversight Board, this was created after, and they're basically, this is the response of the Enron fraud. And what they're trying to do is prevent this in the future. So there was something called the Sarbanes-Oxley Act of 2002, which was supposed to prevent this from happening in the future. Ultimately, once again, the whole thing came crashing down. Now, some of the similarities, and what's crazy about this is what I see is a lot of similarities between the Enron structure and Eversource, right? So if we take a look at Eversource's structure, we have Joseph Nolan, who's the CEO, Paul Chodak, who's the COO, and interestingly enough, John Morea, I'm probably pronouncing his name wrong, but he is the new CFO. The interim CFO, or the CFO prior to that was Philip Lembo. Now, Philip Lembo quit or resigned in 2022. Probably, I'm going to guess, probably 4 or 5 months before the announcement that they were going to have to divest from the wind projects. He retired, but he didn't retire completely. So he ended up becoming a strategic advisor to Eversource on behalf of the wind farm projects. So I'm not saying that that's suspect, but it's, you think about it for what you will. Like, if this person resigned about 6 months before the divestment into all of the wind farm projects. And what's interesting too is the number of subsidiaries that are underneath Eversource. And so we have a complex web again of subsidiaries that carry debt. The difference between Eversource, though, and Enron is that the CFO was responsible for oversight on the subsidiaries in the Enron scandal. You can see here through this line here. But in this one, it's the CEO. So I found some reports that show he manages this directly. And I thought that from an organizational structure was pretty odd. Usually that's handed down. It seems like a lot of work to be the CEO of Eversource and manage the subsidiaries on top of it. And when I see that the CFO had left and the new CFO has come into place for now a few years, once again, you make your own and draw your own conclusions. But when I want to control the flow of information, that's how I would structure that. When we take a look at the regulators, we see some of the same names. We have the SEC, the FERC. Then we have our regulators in each state for Eversource. We have Massachusetts, Connecticut, and New Hampshire. So those are the PURA, DPU, and PUC respectively. And then we also have our ratings boards here again, Moody's, S&P, and Fitch. So what we're going to talk about now is the next, like, what was it that really brought Enron down? So I pulled out 4 big items that I believe are the biggest things that caused the Enron crash. The first one is this mark-to-market accounting fraud. And what this allows them to do is to decouple their revenue from their operations and then predict what their revenue will be and use those predictions as their actual revenue. So the revenue wasn't based in reality or operations. It was a prediction. So they would write a contract, they'd put a number on it, and they would say, since that contract was executed, that's revenue. At first, it was supposed to kind of, I guess from an accounting practice, make it easier. I'm not sure why that was in place. But what it did allow them to do is to use financial trickery to put money on the books that just didn't exist. The second thing that was the big cause for Enron's fall down is hiding the debt through what we call special purpose entities, or these are the subsidiaries that the CFO was running. So by a little bit of financial trickery, they're able to offload debt onto the subsidiaries so that the head company's books look pure. They still reported a profit. When they started to get into trouble, that's when we get into number 3, is when they're borrowing to pay dividends and maintain stock price. Remember now, so the focus of the CEO is not to consumers, to ensure that they have an electrical grid that's working and that the gas prices are fine and competitive. Their pure priority is shareholders. And that's important. Remember that. Shareholder value trumps everything. Also, institutional investors have a little bit of pressure on rating agencies. So Standard & Poor's, Moody's, and Fitch, back in the 2008-2009 financial housing crisis, we saw what happens when institutional investors put pressure onto credit rating agencies to make sure that those financial engines still look good to invest in. A good point to note is once a particular stock hits junk bond status, institutional investors really aren't allowed to invest in that. So there really is a push to keep that at BBB- and above before junk bond status. And the last piece was just the market manipulation, the monopoly creation, and the regulatory capture. And so when we talk about market manipulation, they caused outages in California that just wild brownouts. People's bills were going all over the place. And they also managed to create a monopoly by shoving out competitors. So those are the big 4. So we've got basically predictive revenue generation, where you can just pull a number out of a hat, and that's what your revenue models are. You can hide debt by shoving off it onto subsidiaries. You're now in a borrowing phase where you're borrowing from Peter to pay Paul just to be able to pay off dividends and debt. And then you have your monopoly. So those look like the big key items when I look at the reason for Enron's fall. And the problem is, we'll go back to the reason why I started this investigation was I wanted to see what had happened to Eversource for the wind farm divestment back in 2024. And as I started to dig through the financial models, things just didn't make sense. And I started to see some funny business. And I started to see a lot of things that mimicked the downfall of Enron. So let's take a look at Eversource here. Let's break it out to the big four. So right now, Eversource runs under what we call a revenue decoupling mechanism, which basically allows them to dictate what their price will be in the future, what they need for revenue, and then decouple their operating expenses from their revenue models so they can report profit. Now, it's supposed to maintain and stabilize the company, but we're going to see in a little bit how this kind of looks like the mark-to-market. Same accounting principles that were done at Enron. We're able to not have to predict reality. We're able to define what our revenues are going to be. And for me, that's looks exactly the same. It's a horse by a different color. We also have complex subsidiary structures and debt allocation. So both of these companies went from gas companies to basically energy trading companies. And they host a complex web of subsidiaries underneath it. Where in Enron's case, this was managed by the CFO. In Eversource's case, it's being managed by the CEO. This other thing, financial losses and asset divestitures. This is something that's happening now. We're starting to see some losses on the books. We're starting to see sell-off of like the wind farm, and there's now a future to sell the Aquatica. I forget the name of the water source that they have, but they're looking to sell that asset as well. But it doesn't look like they're in a cash positive state right now. It doesn't look like a net cash positive state. It looks like they're basically borrowing from Peter to pay Paul. And then the market dynamics and energy asset closures. This is another one of those, like, so back in 2019, for those that live in Massachusetts, we had Plymouth Nuclear closed. And when Plymouth Nuclear displayed or made public the reason why they were closing, it was because of the subsidies in green energy that just made it price uncompetitive. Who was the biggest investor into the green energy? Eversource. And the one thing that really struck me out in my investigation was they really pointed out the speed at which the nuclear plant was disabled. Now, I don't see the government move fast on most things, but the speed at which this was disabled and basically made such that it couldn't be easily turned back on was noted in the reports. And I thought that was very, very interesting, because usually you don't see a lot of fast-moving things unless you have a lot of motivation to do so. And if you're trying to create a monopoly or an energy monopoly in an area, killing your competitor would be one of the utmost priorities for me. So now we have these four kind of similar scenarios that we saw with Enron, right? So we have future prediction of revenue that's not based in reality. We have a complex web of subsidiaries that carry debt. We have borrowing and sell-offs in order to pay the current bills. And we have some market manipulation, right? So they do follow each other very, very well. And so I started to try to dive in a little bit deeper. And here is what I can grab from public sources. What I try to bring in everything across the board. So we have our revenue, the income that they state that they made, right? So the net income is based off of what Eversource said that they made. The operational cost to operate Eversource and its subsidiaries. The amount of debt that was added that year. The cumulative sum of the current debt load. the total dividend that was paid out to investors and the end of year stock price. And I know that this is information dense, but what I really wanted to show here in this graph is we have for this last year, 2024, $11.6 billion in revenue. Eversource came out and said they made $800 million. They said the cost to run the business was $9 billion. They paid out almost $1 billion in dividends. And when I look at these across the board, I do not understand how this works, right? So we have $2.6 billion worth of debt for this last year alone that was added to the books. But we have $800 million in revenue. Now, call me silly. I don't know how that works. The only way that I could get that to work is if I offloaded $2.6 billion worth of debt off my books and didn't report that as revenue, or didn't report that as against the operational costs. That's the only way I can look at that. And when I continue to look at the growth, so I put a polynomial model against this to kind of see what the debt at the current growth rate is going to be for 2030. And by 2030, if we continue at the same rate without any intervention, this debt is going to grow to $50 billion. Now, this is a company that's worth, on the books stock-wise, $21 billion. So we're already over in debt what the company's worth in stock, right? So the company's worth $21 billion, and we have $28.5 billion in debt. Any household numbers that we used to model this, they do not make sense. This is a hockey stick curve. We're already on the way up, and this is not going to go down. The problem is when you look at the CEO, so we're going to go back up here. When we look at Eversource, we look at the CEO. Remember, their fiduciary responsibility is not to you, the consumer. It's to the shareholder. So who is the shareholder? Institutional investors make up about 77% of the ownership of Eversource. Of that, the big three that own 30% are BlackRock, Vanguard, and State Street. Their job first is to make sure that the dividends are paid and that the debt is serviced. They don't have to provide reliable infrastructure. They don't have to provide good pricing. All they have to do is make sure that the shareholders are happy. And the shareholders are very happy. And I'll show you why. Because when I look at the debt, guess who owns the debt? Now, this isn't as public information, but when you look up who owns debt, usually the names come up: institutional investors. So not only are institutional investors getting the dividends, the institutional investors are also on the back end on the debt servicing side making money off the debt. So if your big three, BlackRock, Vanguard, and State Street, own both sides of the fence, here's the crazy perverse relationship that we possibly could be in. They're making money on the dividends at 4.2%. And since the credit rating has come down to BBB+, the service rate that they pay is up. It's over 5% now, and that's high for utilities. It's usually between 2 to 3%, but now servicing debt is now over 5%. It actually makes sense from a CEO's perspective to make the shareholders happy, to push the company more in debt because they're making more money off the debt. Yeah. Now, once again, I don't have access to the owners of the debt, but when I looked up who owns the majority of corporate debt, institutional investors are there. So I wouldn't be surprised if this company is in the situation where shareholders don't care because they're making money on both sides of the fence. Now, what's crazy about this is that the way revenue is generated is Eversource basically says this is what we need to make every year. And then they just write that on the books as their revenue, regardless of what the operations say. So if they say we need $12 billion, they write $12 billion, and then all the bills are retroactively adjusted to meet that new revenue model. So that's the decoupled revenue mechanisms. And what I see here is I see since the priorities are to pay the dividends and service the debt, when I look at this model right here, what I see is I see eventually a future where your bills, your distribution and your supply charges, 90% of that is probably going to end up going to servicing debt and paying dividends. There are some clues to this, some things that I'm looking at in the last couple of in the last year or so that point to some of these problems that I'm seeing. So I'm not going to say that the wind farms caused this, but they definitely exacerbated an already existing problem. I think this is probably going to be the camel or the hair that broke the camel's back. And so we're going to look at a couple of things that happened. So in February of 2024, they started mentioning we're probably going to have to divest from this. In September, I think they completed the sale. And they ate about $520 million worth of debt, $360 million of that in unfunded liabilities. So let's go through the timeline. So after February, they realize, hey, we're not going to be able to continue with this venture. We need to divest off of this and focus on our core competencies, which is just energy. Then they passed 2 rate hikes that year, right? Or they tried to pass 2 rate hikes this year, or the last year. One of those was in New Hampshire, the electric rate. They wanted to go up almost 47% on the distribution rates. 47% in 1 year. Sounds crazy, right? And then in November of 2024, they wanted to go up in Connecticut on the gas 43%. And the funny thing about these two things, when I look at the unfunded liabilities of $360 million, they have to pull a note for that. They have to borrow against that. And once you factor in the service charge, it runs about $400 million. And when you look at the 2 rate increases, this one raising about $181.9 million, and this one raising $209 million, these things, when put into effect, would have been able to cover that $400 million note, because once you add 360 plus the servicing debt, I think it's a shade under, a shade higher than 400 million. Now they give reasons for why they need to do this, but I don't think it has anything to do with infrastructure hardening or storm preparedness or anything else. What I see here is this unregulated investment, which is the offshore wind plant. Because remember, you have 2 types of investments. You have unregulated and you have regulated. Now, from Eversource's regulated perspective, that's the stuff that pays for infrastructure repairs, storm hardening, anything that's basically tied into your distribution charge. Just make sure that everything's running. And on the unregulated investment side, they have offshore wind. And what I see here is a push of unregulated investment loss into the regular investment bucket and hidden under rate hikes. That's what I see. Is it true? I don't know. I can only access public information. But when I take a step back and I'm in February of 2024 and I'm the CEO and I got to look at how I'm going to eat these costs, this would be my plan. Divide and conquer. I'm going to put a little bit in Connecticut. I'm going to put a little bit in New Hampshire. We're going to separate the rate hike dates so nobody cross-correlates the 2 of them. And then we'll figure out how the other debt from the 520 will just dump in the distribution charges in Massachusetts. I know they're cash negative. I know they're cash poor because on top of it, they just made a notification for Connecticut that the $500 million they were going to do in infrastructure investments was canceled or pushed back. And what's crazy about this is an ever-evolving cycle, right? So now your infrastructure crumbles in Connecticut. They failed to do what they were doing with the bills in the operational cost to keep this stuff maintained. And they're going to tell you that you need to pay for it with another rate hike. How crazy is that? That's my guess when I look at this. This is what I'm assuming is what's going on. So let's do a quick recap. So let's take a look at both of them. These are the big problems. This is the reason why we're in where we're at. We have these decoupled revenue from operations. This is a big problem. This allows you to basically cook the books, no problem. Put a fictitious number on as revenue, demand that the state has to pay that, and then write that down as revenue, and then shove debt off of to your subsidiaries. The second one is this unregulated investments being funded by regulated assets. I don't think this is legal at all. I don't think this is legal at all. You should not be able to take a gamble, screw up hard, and then force the consumer to pay for your mistake. And that's exactly what that looks like to me. This complex subsidiary structures the high debt. I'm pretty sure a lot of this is being shoveled off into the N-Star and Yankee Gas, etc., so that the Eversource books look good. That's my accusation. And all in all, this business model is unsustainable. We cannot continue to run at this, because what's going to end up happening is your debt is going to go higher. The debt's going to go higher in Eversource. And they're going to just keep predicting higher revenue to make sure that institutional investors, their shareholders, their priority, are paid first. And once again, this is the reason why I stated before, your bill will most likely, if it not already is, the majority of it to pay forward, to pay dividends and debt. There is no way out of this. There's no way a $21 billion company, when they're making $800 worth of revenue or income, so they say, can ever pay back a $28 billion debt. Not when they're looking at their credit rating decreasing, which means the cost is going up. And everybody who's ever filed bankruptcy before knows this. This is the debt cycle that you can't get at. There's one point where you're looking at it, you're like, there's no possible way, even given 50 years, that I'm ever going to be able to pay this back. And that's where we're at right now. We're at the point where this is unsustainable. And for every month that we ignore this, for every month we push it down, there's systems in place that automatically adjust your bills to make sure that they can look profitable on paper. And anybody that's been looking at an Eversource bill now for the last, I don't know, year or so, has noticed the distribution charges inch up and up and up and up, and they don't make sense. None of it makes sense. So what are the next steps? What do we do? How are we gonna to get on top of this? So there is a lot of information that I need. So there's going to be some FOIA requests that are shoveled around for getting into Eversource's books, looking at the debt, and once we get to the one of the real ones I want to see is the PPA loans, right, or the PPA agreements. So when we sold the offshore wind, there are PPA agreements. This is called power purchase agreements. Now, here's the crazy part. We sold it to Ørsted and GIP. These are two Scandinavian companies. They're international. So basically, we put in a bunch of investment into offshore wind. We then had to sell that to international bodies. So we no longer own that. That's somebody else's property now. And I do think that the only reason why these guys bought it is because there's ironclad PPAs that have draconian force majeure laws or regular standards and exit clauses that are just absolutely astronomical. That's what I think. So I want to see the details of that. Couldn't find it online, nothing public about it. But I do know that if I were a company buying an asset, the contracts, I'm sure, are in the billions as far as value. So we're going to engage the media and public to increase pressure. So I've been in contact with Citizens Against Eversource. Next week, next Monday, because we're going to continue this every week until we get answers, we're going to have Elijah D'Souza on. He is the president of the Citizens Against Eversource chapter, and he's going to explain a lot of interesting things about how Eversource makes it very difficult to get to these public meetings, including things like last-minute notices and scheduling them during hours that are just inconvenient for the general public. The next thing we're going to do is we're going to notify key regulatory bodies and lawmakers. The Sarbanes-Oxley Act needs to be applied here. It does. SEC, DOJ, FERC, we need to start sending notifications. I'm going to handle that, and they're going out this week. And then we're going to talk about lawsuits. I think that's the last step. I think a lot of these things have to happen first. But I think we're really close. We're really close. I don't think that this house of cards can stand on its own anymore. I really, really don't. So this is the result of looking at this stuff now for a few weeks. I've exhausted, as far as I can tell, most public data sets in order to be able to do this. So once again, this week's going to be a big one as far as filing FOIA requests, notifying regulatory bodies, and seeing if we need to start applying Sarbanes-Oxley. Because it's just too much to bear. Anybody who opens up the Eversource bill, talking about distribution charges, talking about line items, and what does this mean and what does that mean, I think it's all bullshit. It's a fugazi. These numbers are made up. The person who's making the money right now is not us. It's BlackRock, Vanguard, and State Street. I'm Kevin Millett, and I am the New Bedford Nostradamus, and I have spoken.